Hey, this is Grant's Interest Rate Observer of the Air. Current yield, we call it. I'm Jim Grant himself, and with me, as usual, is the cast, including Eric Whitehead at the control panel, the great Evan Lorenz, who is the deputy editor of Grants, and my son Phil Grant, who edits almost daily Grants. And, oh, yes, we have a special guest today, and his name is Donut Shorts. Well, that's not the name in the birth certificate, but we are honoring the request of our money managing guest to retain his anonymity, not because of anything licentious or suspicious in any way, but because some of the topics are just a little bit sensitive, having to do with positioning and with getting your short run by the stupid sell side, which wouldn't know a value if it saw it and looked it in the eye. I says, sorry, I'm Mr. Donut Shorts. I'm emotional about these things.
It's Monday.
Yeah. So we're because this is kind of an informal gathering, we have known our guest for a long time, and we can attest to his, first of all, his professional competence and indeed success, and also to his fidelity to the principles of buying low and selling high, or of selling high and buying low. So, Donut, welcome.
Thank you. It's great to be chatting with you.
So I don't know. I'm going to ask something to begin with. I mean, people buzz on about this narrative called an everything bubble. I don't know, Donut. Do you see an everything bubble, or is it a bit more selective than this?
I guess I would lean towards the everything bubble. I think we've got a monetary environment in which money and capital is being created at a very rapid pace that kind of eventually finds its way into every nook and cranny of the capital markets and more or less every industry out there. So I think there's probably some areas where it's more prevalent than others, and things are more distorted than others. But yeah, I would say it's an everything bubble.
So Donut Shorts, with that in mind, it's an everything bubble. We're also in month 124 of the longest business expansion in U.S. history. How do you position yourself for this? How do you, first of all, get longs in that might make you money and shorts to protect you from the downside?
On the short side, we've tried to focus on things that are basically out of borrowing capacity, which is a bit of a moving target. But
now, can you explain that to our lay listeners? What does that mean, out of borrowing capacity?
Well, essentially, either covenants, if they have any, of course, most people don't have a lot of these days, and it's typically some kind of senior borrowing capacity that they're running out of, and companies that are sufficiently distressed that people won't lend to them on an unsecured basis any longer, and they've got some inherent problem in the business where they've got deteriorating fundamental economics.
Can you give us an example of what you mean by that?
Well, the mall business is one that I've tweeted a lot about. So that would be one example. Or there's certain parts of the pharma business today that have litigation exposure, or have products under competitive assault. That would be another example. Some parts of the telecom business would be another example where either technological changes or regulatory changes are affecting certain segments of the business.
Tell us, money managing guest known as Donut Shorts, tell us whether you see the short side as a profit opportunity. Is it in itself, or is it a hedge? Are you principally long, and are you finding long opportunities?
We view it. I think we view it both ways. As both the short side is both, a profit making and a hedging vehicle. It's certainly gotten more difficult as time has gone on. Both because you're fighting this wave of monetary beneficence out there, as well as the fact that things seem to get crowded a lot more quickly than they used to. So, but I think you can still point to examples of where it's profitable and where it does provide a hedge. On the long side, the economy is still growing, and there's still a fair level of innovation, and productivity has picked up. So I think there are still opportunities on the long side, notwithstanding the fact that that nothing is cheap these days.
Without giving away too much of your background, you've prospered through more than one cycle. When you look at your net exposure now, which is basically your longs minus your shorts, what is your net, and how is it compared over time? Are you more conservatively positioned than you have in the past?
We're a little more conservatively positioned than we were, say, at the start of the year, and I think that reflects a view that there's more risk in the economy now than there was, say, a year ago or 10 months ago. But we're not nearly as defensively positioned, say, as we were in 2007, for example.
The Schiller cyclical or cyclically adjusted price earnings ratio is now at like 29, which is the highest level outside the year you know what and the dot-com boom. So you mentioned that there are things to do. Where do you find them? Be more specific if you could be. What industries, indeed, we would like a name or two if you were in a mood to vouchsafe one.
One thing we are long, which may not exactly fit what you're looking for, but we're long gold, which is a position we've had for a while, and which is not generated much return for several years, but has recently done better. And I think that reflects the fact that we've got negative real rates out there, and probably the prospect for more of that to come. So that's one thing that we are long. We're long. One thing that we're long is a company called Seaboard, which is a play on the pork marketplace. There's the swine flu going on in China at the moment, and there are some. If you kind of hunt around, you can see what's happened to the Chinese hog population and what's happened to prices, particularly in the last 2-3 months. So we think that they could be a beneficiary of that going forward.
In your nom de Twitter, Donut Shorts, which is how we're referring to you now, you do some of the best job of anyone I've seen out there of kind of cataloging all the problems that are happening in various aspects of real estate. And one thing that really struck me is just about every part of New York real estate seems to have a problem. You've noticed the extreme glut of empty storefronts in kind of the tonier parts of Manhattan. You've noted that there's a giant glut of luxury condos. I think I saw a New York Times article that said something like 2/5 of all luxury condos built in the last 8 years are vacant. And you've also noted the myriad problems at WeWork, which is one of the largest tenants in the city. Now, historically, people have paid up to gain exposure to Manhattan real estate, thinking that it's less cyclical and it's just a better, place than, say, I don't know, Salt Lake City or places where it's easier to build.
Also, it's a destination for flight capital.
For flight capital.
Correct.
If we do have an economic downturn, and again, not predicting one, might Manhattan disappoint all the people who paid really fancy cap rates for various properties?
Yeah, I think there's definitely the possibility of that. I mean, I think it's probably already disappointed some people, particularly if they invested in retail properties in Manhattan or as you say, in the very high-end residential condos that were, say along 57th Street that were built in the last few years. So I think you had, in a way, kind of each market has its own influences, but for some of these, you had kind of a perfect storm. The coastal markets were the ones that, after the crisis, that investors went to first in their search for basically bond substitutes as rates were pushed down. And, the luxury condo market in particular, I think, got hit by a combination of de Blasio changing the tax inducements for building condos. So the old one was due to expire, and they had not yet detailed what they were going to do, what they were going to have to replace that. So everybody that had a project that was kind of in the pipeline decided to rush ahead and build those at once. So that created a kind of an unnatural supply bump. And at the same time that happened, you had both the dollar get stronger and, an increasing focus on capital flight and money laundering. And the Treasury Department implemented regulations that forced people to reveal the ultimate buyers of property. They couldn't use nominee entities like LLCs to own and purchase real estate. So I think those things kind of converged at once on the residential, the high-end residential marketplace, as well as the SALT tax changes came soon thereafter, which took a lot of, certainly some very high-end earners out of New York to places like Florida. So there've been kind of several forces that have converged on those properties at once. And on the retail side, that's what's happened. I think is a function of both the loss of share to online retailing, as well as the increase in the dollar for tourism. And a lot of these places, particularly along places like the corridors like Fifth Avenue and Madison Avenue, were basically these flagship stores that people built, were viewed as, in many ways, brand building exercises to expose a brand to a very large international audience. And so those things have both hit those spaces, and the whole notion of a flagship store is something that I think most brands are now pulling back from, and either not building them at all or downsizing their presence in New York quite dramatically. So those things have hit those spaces. A lot of the vacancies, I think, are driven by the fact that the landlords have capitalized buildings back in 2013, 14, 15 when rents were much higher, and if they had to re-rent the spaces today at the current rental rates, given the amount of debt that they have on the properties, they probably lose them when it comes time to refinance them when their loans are due, which usually typically
Who are the
10-year loans.
lenders? Who owns the mortgages?
Yeah, so it's a combination. There are some in the CMBS market. There are some held by banks. There are some held by private debt funds, and we haven't. SL Green owned a piece of mezzanine debt in one of the properties down in Soho that they recently foreclosed on. They talked about that in a conference call or two ago. And there are Joe Sitt, who runs Thor Equities, has had several of his, and he kind of top ticked the market back in 13 and 14, and he's had several in the CMBS marketplace that have gone into special servicing that are probably likely to be auctioned off not too far down the road. So we may get some repricing events.
Are any of the New York-centric banks like
properties
Signature Bank have particularly heavy exposures to commercial real estate in the city?
Well, they definitely have exposure to commercial real estate. Probably, I think Signature probably has more exposure to residential multifamily. I think most likely. Although a number of the smaller multifamily properties have commercial space at the bottom, which I think is a kind of a risk that a lot of people have glossed over. So depending on, again, the neighborhood that you're in, there may be risk to the income stream on those loans as those retail spaces reprice in the rental market.
Hey, everyone, Mr. Donut Shorts, everyone seems to have an opinion on interest rates. In that respect, I guess, a little like the weather. And there is one school that says that we are, in America, we're still positive. We still offer extraordinarily, actually positive yields. It's amazing. We have like a 2% yield on something. Yeah,
indeed.
Above zero. Whereas in the rest of the world, the $15 trillion worth of the world, there are negative nominal yields. And they say, continuing this line of observation and argument, that either we come down or they come up in yield. And they're not coming up. Ergo, our yields are going to collapse. Now, with all that windy preface, do you have a view on the bond market, on pure rates? And if you consider these rates to be too low or even bubblish, have you considered making a statement by shorting bonds?
So I think the path of least resistance is probably lower on rates for us, just purely based on what's going on in the rest of the world, as well as the fact that global GDP seems to be slowing in aggregate. And the Fed's posture, while maybe a little bit uncertain, seems to be towards more easing. So I would expect that rates will probably continue to drift lower, but we haven't made any bets in that regard. But I think at the end of the day, the powers that be will want to hold on to their jobs, so to speak, and will throw everything they have into the breach in order to hold on to their jobs. And the catechism among the monetary establishment, as you have well documented, seems to be even more is better as far as negative rates go. So I don't see that pressure abating anytime soon. It doesn't seem.
Well, the world economy will be what it is, but QuickBooks, certainly, the ecosystem business people can help us make what is a little bit bad a lot better. Ladies and gentlemen, you know that I'm always on the lookout for ways to help you improve your business. And, if you're self-employed, as some of us are at this microphone, you are constantly on the prowl for that little edge. And you want to avoid the headaches. You want to avoid expense. So what do? Well, you look for QuickBooks. You manage your entire workflow from the first estimate to the final payment using Intuit QuickBooks. Now, it says here to discuss how using QuickBooks saves you time, money, and hassles. All right, we'll do that. For example, there's the accountant that doesn't come in anymore. What's his name? We forgot already. But that is, we miss him, but we don't miss paying him. They're the 1099s that we can, that help us keep track of all sorts of miscellaneous income, that which we have and that which we are aspiring to receive. And QuickBooks will help you make direct payments. Yeah, you can just pay your bills from QuickBooks. So this is a one-stop shop situation. You won't have to learn how to use thousands of tools and software. Intuit QuickBooks does it all. It's the only one you need. Having all the tools you need in one place helps you make people more productive. Yeah, that's what it says. Okay, easy to use. You can work smarter, not harder, thanks to how easy it is to use Intuit QuickBooks. Okay, call to action. Give Intuit QuickBooks a try, and you're going to love it as much as I do. Learn more about smarter business tools at intuit.me/grant. That's intuit.me/grant. We use it here at Grants, and you should use it too, ladies and gentlemen. QuickBooks. All right. So let us resume. Evan, do you have something for our guest?
Mr. Shorts, you said that you don't specifically have a rate bet on, but you said at the beginning the shorts are tilted towards dead men walking, companies who have over-levered balance sheets. What is the risk to, I guess, corporate America if rates do rise, just given how much leverage companies have taken on this cycle?
I think that's a real risk, and I think in part that's why I think we had kind of I guess we didn't call it a taper tantrum last year, but something kind of akin to that, where when the Fed started to reduce its balance sheet. That created all kinds of worry and consternation amongst people out there, and I think that reflects the fact that there's a lot more leverage in the system, both at the corporate level, I think, as well as at the consumer level. The Wall Street Journal did a big story on car loans last week, which I think is another kind of manifestation of the monetary environment that we're in. So I think that's a real concern, and but also will probably, to the extent that the economy does heat up down the road, will probably mitigate interest rate increases because the economy has, the global economy has much less resiliency in it, given the amount of leverage that it's carrying.
Hey, what do you make of political risk? The Journal says editorially that with Trump evidently wounded and Elizabeth Warren coming on strong, that we are staring a more or less socialist regime square in the face. Do you buy the premise? And if you do, how do you position yourself for the possible outcome?
It's probably underpriced at the moment. I guess as we kind of get into the next year and the spring and the primaries unfold, that may, there may be some repricing on that. I guess part of it depends on what your view of, the congressional elections looks like, and if the Republicans can hang on.
Mr. Shorts, I think what Jim is asking is, if socialism really is our future, how do you go long other people's money?
Yeah, well,
I meant to say that. Yeah, that was my question.
Well, I think there are certain certain industries like healthcare, like energy, oil and gas. Some of the people that run say private prisons, that kind of thing, would probably have pretty big targets painted on their back in in either a Warren administration or in a much more socialist environment, if you will. So I think you probably want to rethink your industry weightings in the event that came to pass.
In terms of energy, it is my understanding that you are active in that sector, hopefully short. How do you view, I guess, the gives and takes there? On the one hand, IHS Markit now says discoveries are the lowest level they've been in 70 years. And in as much as we are producing more electronic vehicles, we still have a lot of internal combustion engines, and it seems like we will have demand for oil for some time now. Nonetheless, Brent, WTI continue to plumb. It's not those, but they're sinking. What's your view on energy and how to play it?
Yeah, I think it's going through potentially an inflection point. I mean, it seems like the flow of capital into the business is now has been constrained to some kind of a critical level, and we've had a series of discoveries in the U.S. and capital has kind of initially it chased gas and it chased various basins around the country, and then it switched to oil, and the returns in all those fields and different product groups got competed away essentially. And after basically a decade of not returning any capital to the shareholders in the aggregate, people are now, I think, finally saying, okay, where's the beef? What's the return? What's the yield in all of this? So of course, it remains to be seen exactly how it'll play out. But it appears that the money available to the Permian is finally being crimped. Some of the assumptions that people were making about the density of wells that could be drilled, as well as what the decline curves on those wells might ultimately be, are being challenged as well. So at least in the U.S., we may be at a point where supply growth is either ending or is going to move forward at a much slower rate than it has in the past. My crystal ball about the rest of the world isn't as strong, but clearly a lot of the traditional sources of growth, like offshore, have been capital starved for quite a while. There are a lot of political entities that are dependent for their political survival on pumping a lot of oil. So I think there's still a lot of incentive for people to produce as much as they can in order to kind of keep the natives from getting restless, so to speak. But but I think we appear to be at some kind of a tipping point in terms of the amount of capital that's available to the industry, and so we may be at a point where supply and demand. I don't think it's around the corner, but perhaps in a year or two, comes back into balance, and it may be a more supportive environment for oil prices and ultimately investment. But it still looks a little early to me. Having said that, it's interesting to see Sam Zell decide that it's time to invest in the oil business, which I don't know if he's even done that before. If he has, it's probably been a while. So that's kind of an interesting marker out there.
He's good company, Sam Zell.
Yeah.
I don't know. We spoke long ago, Mr. Donut Shorts, about the taxi business. And I see the New York Times is running a series of stories on how New Yorkers have corrupted the finance and the operating economics of the taxi business, which brings us to Uber. Have you got a position in Uber?
We're short a little bit of Uber. It's a small position, but I think notwithstanding their success in decimating the taxi business, I think that again, we're kind of still looking for where are the returns in that business, and in particular, I think the money that they have to spend to attract new drivers is really challenging the economics of the business, and it's a little surprising that what is essentially a duopoly hasn't been able to produce better margins, better profits in the space, and perhaps that will happen at some point. But there's no evidence at this point that they'll do that. And I think a lot of these companies, and WeWork is probably the ultimate example of that, but have all grown up with cultures where money was essentially viewed as free, or there was no capital constraint, and the need to generate profits was something that they get to way down the road, and you wonder how many of those cultures will be able to really pivot effectively to an environment in which they actually have to deliver cash at the end of the day.
Well, it seems awfully unfair. These environmentally correct and idealistic entrepreneurs ought to stoop to make a GAAP profit, but I guess we can.
How pedestrian, right?
Yeah. Well, Mr. Donut Shorts, this has been very interesting indeed. Now, before we part company, you have what's this expression on Wall Street? High conviction. When people say, "What's your best idea?" I say, "Well, ask me in 2 years, and I can tell you what was the best idea. As it is now, I can tell you my most vehement idea, but the best idea is probably the least vehement in some way." Do you have a favorite, long or short?
Well, one that we've added recently is SoftBank on the short side. And I think that they will struggle to see any return on the Vision Fund as a result of the investments that they have in the fund, as well as the structure of the fund itself, which essentially puts leverage above with a guaranteed or preferred return above their position, and in which they've essentially force-fed money into unicorn and other early stage companies at rates far beyond what they could productively employ, and that seems to me to be destined to end in tears. So, not for
the shorts, though, right?
Not for the shorts, no. Not to mention the fact that the parent company is quite levered. So that's a short position that we've added recently, which I think probably has room to run on the downside.
Now, is it easy to borrow those shares? And in general, is the operational side of the short selling business in an easy way? Can you borrow the shares you want to sell short?
So we put our position on in Tokyo. There are ADRs that trade here, which we have not been able to borrow, and they're not as liquid as the shares in Tokyo. But borrowing those shares has not been a problem in Japan to date.
One last question for you, just given your focus on SoftBank, and again the fact that you do such a great job of cataloging what's going on in real estate. WeWork is probably SoftBank's biggest investee. It's also probably its biggest problem. WeWork is also one of the largest tenants in both New York and London. Are there any non-obvious ways to play, I guess, a calamity with WeWork, which probably is the firm that has engaged in the greatest liquidity transformation of the cycle by taking very, very short-term leases from customers, but agreeing to very, very long-term leases for the buildings it occupies?
I don't think the fallout from WeWork is going to be cataclysmic. Let's put it that way. There's a bit of a stock versus flow distinction I think to make as a fraction of the stock of leased office space in those two markets. They're still quite small, and so I think ultimately the market will probably absorb that, and an increasing number of their tenants now are enterprise tenants who have the ability to, they're credit tenants that can lease on their own. So to the extent that WeWork is not there to offer them space and they're continuing to grow and need more space, they will probably just go and lease directly. You may see some net reduction in demand, perhaps among the very smallest tenants who may not be, credit worthy and may go back to working out of the neighborhood Starbucks or their apartment instead of a WeWork space. And there probably will be some. They were a fairly substantial portion of the office space leased in the last year or two in New York and London. So there may be some near-term pressure on leasing rates as they exit the market, but as a fraction of the total book of business of a big landlord, it probably won't have a dramatic impact. There'll be some buildings. There are some buildings that are either completely or largely leased to WeWork, and so they may find themselves without a tenant that's paying rent all of a sudden. So there may be some loans that go bad. So there may be some ways to play it through the banks, but to date we haven't been able to identify a bank with tremendous exposure to WeWork. I mean, obviously, J.P. Morgan probably from a reputational standpoint has some exposure, but probably not from, a total balance sheet exposure.
Well, Mr. Donut Shorts, thank you. Ladies and gentlemen, thank you for listening. And on behalf of the entire Current Yield, I think the word is now team, right? Everyone's got a team?
Squad.
Well, I'm thinking that the inside team, not the traveling team, not the squad that plays only home games. It's the team. Anyway, thank you, ladies and gentlemen, for listening, and we will talk to you again soon.